With that said, we're on time for Camilo Nino. He's the founding partner, CEO of Linkvest Capital, LV Lending. They've been doing some really great things. Even during this crisis, Camilo's has a lot of information on transactions that are happening in the marketplace today. Camilo, are you here with me?
Yes, Michael, I'm here. Do you
Okay.
hear me?
Yes, I can. I'm going to stop sharing my screen so that you can project your screen.
Perfect.
All right, hang on 1 second. There we go.
And let me know when you see mine, please.
I got it. It's perfect.
Okay, so we're ready to start.
So Camilo, just heads up, I have fire alarm tests and somebody jackhammering in the office above us. So I'm gonna put myself on mute. Give me a couple of like extra seconds to respond to you if you need me for anything. Okay.
Okay, perfect.
Thank you.
So everybody can see the screen now.
Yes. Yes.
Okay, Michael, first of all, thank you very much for this kind of events during this pandemic. It's been really useful, informative, and I think it's a new way to have networking, share ideas, and even learn from other people in the industry. So I think we all have to be really thankful for the effort that Flya is doing. My name is Camilo Niño, founding partner and CEO of Linkvest Capital. We are an alternative co-investment platform, which means we identify opportunities, structure opportunities, alternative investment opportunities, and then we co-invest with the family offices or high net worth individuals or institutions that we invite to co-invest with us in a deal by deal basis. We are not a fund. We have a deal by deal structure. And one of our main products is doing private loans, bridge loans, which is why we decided to do this presentation about the private lending solutions during this crisis. And what is the role of private lenders and what are the differences of private lenders. We've been doing this. We start pretty small in 2010 until after the previous crisis. We've been doing this for over 10 years, almost 11 years. And we have seen how the market evolved and what is the difference back in 2010, 11 compared with the current condition, the current crisis, and the current competition landscape. So the topic that we're going to discuss, and hopefully we can have a lot of questions. I will finish at 22 minutes to see if we can have a more open discussions and questions. But the topic is real estate collateralized operations have always been, and I want to say this, have been, are, and will be one of the most important types of financing available for individuals and institutions. This is not a new business. You can call it hard money lending, private lending, bridge lending, shadow banking, whatever you want to call it. But any kind of financing done by non-traditional institutions or either banks or agencies or insurance companies is what we call asset-based lending or bridge lending or private lending. It's interesting that during crisis, access to funding becomes, of course, more difficult for sponsors, developers, and real estate investors. And one of the sources of funding that stops working and that has a big impact in the access for funding is the traditional banking system and the traditional lenders. So it's during the time of crisis that a lot of private capital, a lot of private lenders, a lot of bridge lenders take the opportunity and take the lead to be an unstable and an opportunistic source of capital. And we believe that contributes to the economy and to the recovery during difficult times like the ones that we are living now. that's our topic and that's our hypothesis. We will have 5 different points to discuss. Here are the main points. Is first, different approach from private lenders and traditional banking. Second, the US private lenders market overview. Third, what to expect from private lenders during crisis and how can we compare 2008 and the current crisis and the today market. 4, main differences among private lending solutions. Because as I just told you, everybody that has some capital and wants to do a loan collateralized by a real estate property is basically a private lender. And fifth, overview of the type of transactions and the kinds of deals that we are seeing in the market today, that, for example, that we are closing as LB lending, and that we think are going to be the opportunities in the next coming months while we recover from this crisis. So first, different approach from private lenders and traditional banking. And I would like to mention that private lender normally should be used as a bridge lending solution. And here we need to understand that a bridge lending solution means that you have an initial point where you need the financing either to buy the property, to refinance the property, to buy out a partner, to buy a property at a discount and create some value. Any business plan that the real estate investor or developer or sponsor has, but it has to have a short-term or mid-term point where you either bring a new partner or you bring a new source of capital, you refinance with a traditional lender in a much better conditions, mainly the cost of capital, or you sell the asset. So that's why we like to think as private lending as a bridge lending solution and not as a permanent solution. That's one of the main points of the different approach from private lenders and traditional banking. Inside the private lenders also, you need to understand and really do your homework of what is the goal and what is the approach that your private lender takes, because there is any kind of private lenders that just want to put some money to work and get a nice cash flow, but they are not dedicated to this business and they are not professionals in the business and don't have the structure to manage complexity or complex deals. There are some people that really wants to keep your property, so they lend to own and they're aggressive in terms, but the reality is that they are waiting to get the property at a discount. So normally you need to verify that the interest or your interest as a real estate investors and developer is aligned with the interest of the lender. One of the main advantages that we have as private lenders is speed, which for an opportunistic approach or an opportunistic deal is really important. We have done deals where we close as fast as 10 days, and there's no way that a bank can do that. The banks and the traditional lenders are big institutions. They have lengthy processes, a lot of bureaucracy, and a lot of regulation. So the flexibility and the speed that we as private lenders can offer is I think is one of the main advantages and one of the main differences between the traditional banking approach and the private lending / bridge lending approach. We as a company, Linkvest, we do the lending side, the bridge lending side through LB lending, Linkvest lending, but we also have an entity or a line of business where we acquire properties and we use bank financing and we co-invest in multifamily projects as co-developers. And in those two, of course, we use traditional financing, and we have had the problems and the issues of a lot of banks delaying the decisions, not taking the decision, telling you excuses that the committee, the audit, the regulators, etc. And so you never know when you really are going to close. And I think that's one of the main difference, speed and flexibility that the private lender can offer. And for last but not least, approach. What is the approach? What is the idea of the private lender? And how can we identify ourselves with the sponsors? Our slogan as a company is developing long-term partnerships, and that's the goal, and that's how we act when we are going to do a deal. We are not looking at the transaction. We are looking at the relationship and developing a long-term relationship when we can do more deals, maybe as lender, maybe as pref equity, maybe as partner, maybe as co-developer, but always developing and valuing the relationship. And that gives us the possibility of be sometimes more flexible, support even in difficult times like the ones that we are having now, our sponsors and our properties, because it's in the best interest of the investors, the sponsor, and us as lenders to figure it out and to work together. So I think those points are the main different approach that traditional banking or traditional financing versus private lenders we can find in the market. My second point is one of the most difficult parts, which is understanding the market, the private lending market. We call it US private lender market overview, but really is to show you that it's really difficult to get access to data because private lenders are not regulated. You really, there is a gray zone, but you really don't need to be registered with the state, for example, or with the SEC or with the Fed for the private lending transactions. So there is no data, there is no benchmarking. It's difficult to get that data to do analysis. And so you can compare yourself with other lenders. We have been trying to do that. We are part of some associations. We discuss with our colleagues as we know most of the competition in our market. But it has to be done in a deal by deal cases. There is no sources like the Mortgage Banker Association for the banks or the Fed or the even Fannie Mae or Freddie Mac for the agencies. So that's one of the challenges of understanding the private lending market overview. But we have some data and some information that we want to share, at least to show you the size of the market, the size of the opportunity for private lenders, and the importance that private lenders can have in moments like this one in crisis, where traditional financing normally goes down or become less available, and we as private lenders can step up and be a source of funding to keep the engine working, the economy. So as you can see here, this is an example, second quarter 2020. Only in second quarter 2020, there were over close to 44 billion in new originations for multifamily mortgage debt, which can be similar to the asset-backed loans focused on commercial and multifamily properties. The total outstanding by second quarter 2020 is close to $3.8 trillion. So it's a huge market. Out of those 3.8 trillion, commercial banks is the biggest, has the biggest share in the market, close to 40%. Agencies, 20%, life insurance companies, 15%, CMBS and CDO loans, close to 14%. And there is a group which the Mortgage Banker Association called others, which is close to 11 or 12%. And we can think that private lenders are in that group. It's not only private lenders, but a big part of that group could be considered private lenders, as we think, and as I told you, that everybody that has private capital and that do mortgage loans, commercial or multifamily loans with real estate collateral can be called a private lender or a bridge lender. But as I mentioned, private lenders do not have reporting requirements, and there is no data that can be consolidated, so it makes the analysis quite difficult. What you can see is there is a market that is continue to grow and that has a lot of potential, and because of the size, there is a lot of opportunities for private lenders and private capital to get and to get involved into this kind of loans and to differentiate from the traditional financing, being more flexible, having the speed, having the long-term partnership approach that we discussed. Again, if you go to Google or you try to search how many private lenders are in the US, you can get numbers close to 3,500 without knowing if all of them are active, if they really do private loans and mortgage loans, but at least that they come themselves private lenders. There is only one association, which is called the American Association of Private Lenders, where you can find 165 private lenders registered with the American Association of Private Lenders, that at least you can know that they are dedicated to do private loans or bridge loans. But again, there is a huge space and a huge need to have more data, more benchmarking, and maybe more consolidation of the information to be able to understand how this industry works. What we can see, even without all the data that I just mentioned, is that during crisis, and we can compare here this gray space in 2008 was the former crisis, and this space in 2020 is the current crisis or the current environment that we are living because of COVID. And you can see that, for example, commercial banks, they peak before the crisis and they start reducing their exposure and their growth in the next 1, 2, 3, or even 4 years after the crisis. And then it takes a lot of time to recover the same levels before crisis and to growth. This space is what we see as a huge opportunity and as a huge requirement to get professional bridge lenders, because the funding requirements are still there, and someone has to step up and someone has to provide the access to capital. And that happened in 2008, 9, 10, 11, and 12. And I told you, we start at that moment, 2010, and we saw how that works. At that moment, it was really difficult to get access to capital. And even if you want to be really conservative as a private lender and be restrictive in your offer, you get a lot of requirements and a lot of requests, because most of the banks or the traditional lenders were not moving fast enough or were not moving at all because they were scared because of the crisis. And we suspect that maybe that's going to happen again in the next couple of months. It's been happening in some specific kind of transactions like construction loans. Construction loans was frozen from March up to August maybe, from traditional banks and the traditional entities that finance construction loans. And we think that is going to continue to happen in the market, which will be a challenge for real estate developers and sponsors and investors, but will be a great opportunity and a good environment for private lenders like us. Same story with insurance companies. As we told you, it's the second biggest group. Happened the same after the previous crisis. And we see that it seems that it's going to happen again in this crisis. So these kind of sources of capital that when the market is expanding are really aggressive, tend to become really conservative or stop doing loans during and after the crisis. What to expect from private lenders? We think that similar to 2008, there's going to be a great opportunity. It's going to be a riskier environment because, of course, it's more difficult to quantify risk and to measure risk today than a year and a half ago, because we don't know yet what is going to be the implication in the real estate market, what are going to be the short-term and mid-term changes that the COVID crisis will generate in the economy, in the consumers, etc. We don't know when the hotels and the hospitality industry and the retail is going to recover, if it's going to recover the same as it was before, etc. So it's risky, and you have to be pretty cautious, but also there are a lot of opportunities because the capital is required anyway. And actually, normally is more required when there is a crisis than when everything is going well and the liquidity is there from the traditional financing. So we think the opportunity is huge. We saw in the market from March to August a lot of changes because there are different kind of private lenders. There are private lenders that use leverage from either debt funds or banks or insurance companies, etc. And if you depended on those sources of funding because they stop, you have to stop as a lender, as a private lender. We, in our case, for example, we don't use leverage. We have our own funding. We work with private investors, family offices, high net worth individuals, which tend to be much more stable. And for us, they didn't stop. They continue to like to invest in loans, and that's why we continue to be able to get the capital to fund our deals. But there were a lot of lenders that had to stop doing loans because of the structure of their capital, of their sourcing structure. Correspondent lenders, most of them stopped because also they depend on a debt fund or on an institutional buyer that will buy all the loans that they originate. If they stop buying, they cannot comply with their commitments, the lenders, the correspondent lenders. And we saw a lot of transactions that didn't come through because the correspondent lenders didn't have the capital or didn't have the commitments from the traditional sources of funding to be able to close on time. Another thing, interesting thing that we are finding and that we are getting is that because banks and traditional funding is really slow and difficult to get on time, at least, even great sponsors, good developers, and great properties, they have to use bridge lending. So we are getting access to what is normally a bankable deal. We are getting access to those deals because we can move fast, and the sponsor or the developer or the real estate investor understand that the most expensive capital is the one that you don't have when you need it. So even if it's more expensive, the capital, as a short-term solution, at least they have access to capital when they need it. And that's why they have to be able to use the private lending solution. As I mentioned, one of the main opportunities, construction lending, because the banks don't want to do construction lending or are really scared on construction lending. There is a lot of opportunities. It's not for everybody because construction lending requires a different structure and requires understanding the process, having the controls, the team, etc. But if you can do it, there is a lot of opportunities to grow in the construction lending space in the next 6 to 12 months because banks are not moving forward as required by the developers. And also from the source of capital and from the investor's perspective, we are in a really low interest rate environment. The Fed already said that we will be in a low interest rate environment at least for the next 2, 3, 4 years. So everybody's chasing for yield. Everybody's looking to put their money to work. There is a lot of liquidity. So there is a lot of people looking for safe ways to get interesting cash flow returns, and the private lending product we believe is one of the most, if you do it well, if you do your underwriting well, if you operate and service the loans well, if you develop the relationship with the borrowers, you can have a pretty stable and secure product for investors that generates much better returns that most of the alternatives that you can find in the market with similar risk, and that gives you the yield that most of investors are looking for. My fourth point is that not everybody is the same. Every private lender or every lender is different. And if you are going to work with a private lender, either from the investor's perspective or either from a developer or real estate investor perspective, you have to do your homework. You have to understand the reputation of the private lender that you are working with. You have to understand what is their goal and their idea and their approach. We call it the good, the bad, and the ugly. In every industry, you find good people, bad people, and ugly people. But when the industry doesn't have regulation, when the industry doesn't have data, when the industry doesn't have benchmarking, it's much more difficult to assess who is the good, who is the bad, and who is the ugly. So that's why you need a lot of homework, base your decisions on reputation, meet the lenders, the private lenders, and try to develop a relationship to see if you feel safe and secure to move forward. A good part is normally in private lending, you will have access to the decision makers and the owners directly, not like the traditional banking and the insurance companies, etc., where you work with a originator from the entity, and that's all the contact that you have. Here you will be dealing, in our case, you will be dealing with us, with the owners. And I think that makes a big difference because that gives you the opportunity to understand and feel how the private lender thinks and what is their approach, and for the private lender to develop the feeling and the relationship and the trust on the partner, because it's really a partnership when you are putting the money for a development, a construction project, an acquisition, etc. You are becoming a partner until they pay you. So do your homework and understand the difference between the private lenders. And as a summary, just before finishing, I do believe that private lending is a great bridge solution, but again, it has to be a bridge solution, not a permanent solution. I do believe that private lenders play a big role and can be really useful in dynamizing the economy and the recovery, because we have different approach, different risk profiles, different sources of capital, more pension capital, and we can think longer term than the traditional banking. So I do believe that private lenders can be really useful and can be a great tool for the coming period that is going to be the crisis, post-crisis, and recovery. Again, we need more data and we need more, maybe regulation, but at least data and information to be able to assess and understand the risk and the conditions of the industry. And finally, construction loans, if you have the structure, if you have the team and the experience, there is going to be a lot of opportunities in construction loans for private lenders because of the banking restrictions. So I don't know if we have time for questions, or you would like to discuss some of the transactions.
Yeah, discuss some of the transactions and stuff you've been having success with, and there's some questions in the Q&A box as well.
Perfect. Just one or two questions.
I'm going to yield 10 minutes of my time to you. I don't need a full 30 minutes. All I need is 20 minutes, so you can have an extra 10 minutes.
Oh, thank you. Sorry. One of the transactions that really helps to show you an example of how we can work as private lenders is the acquisition from state companies, a really reputable multifamily developer here in Miami. They found a great opportunity in Hialeah, acquire a closed and distressed asset, a hotel. They bought it and they got a great deal, but they have to close in less than 3 weeks. When they came to us, which we know them for a long time, actually we partner with them in some developments, so we have a good relationship with them. We lend them 11.5 million to buy this asset. It was a short-term 4-5 months deal. We closed in 2 weeks, and the main reason that he needed someone that he can trust is because he had 1 million in deposit hard, so he had to close, and that's why he got the deal. So these kind of transactions, when you need to be sure, you need to make sure as a developer, as a real estate investors, that you can count on your financing partner to close. because you got a great deal, because you got aggressive in the offer to close fast, not financing contingency, etc. That's the perfect example where we can perform and that where we are a really useful solution. Even if we are more expensive, we can close and we can be your partner to close these kind of transactions. And this is basically is going to be a reposition of the asset. They're changing the use from hotel to multifamily, which is what they know how to do. And like these kind of opportunities, we think that there are going to be a lot of opportunities in Florida, where we are focused, but in the US also, to reposition hotel assets, retail assets, office assets. Repositioning of the assets is going to be a huge part of the recovery or of the distressed market. But you need to be able to be aggressive on the offer to get the assets as an investor. And also you need to make sure that the financing partner is there and can close fast, can move fast, and has the money to close. Other kind of financings we have done in Orlando downtown. One of maybe in downtown is the only acre that is pending to be developed in that specific area with permits, but they needed to refinance because remember, before the crisis, refinancing, getting access to construction loans, extending the loans was pretty simple. When the crisis came, most of the lenders became really difficult to work with. So they are not willing to extend the loans. They are not willing to increase any loan amount. If they were working in a refinance when a construction loan, the lender stopped working with them and delayed the decision. So we have found a specific niche that is really interesting in being the short-term or mid-term bridge for the developers or real estate investors that could not get their exit as it was expected, where their plan got delayed because of COVID, either to get a partner, either to refinance the property, either to get a construction loan, or to close the sale of the asset before the loans mature. So there's how we can finance that short-term or mid-term period while they can put everything together to execute their business plan. So there are a lot of specific transactions where even though we are more expensive than traditional banking, we can be a great financial tool and a great financial partner for a lot of developers and real estate investors. And also from the other perspective, a pretty stable and safe opportunity to investors that are looking for yield, for a fixed income opportunity with real collateral, secured by a real collateral, and worst case scenario, at least they know that they're not going to lose their money because there is a real piece of real estate securing their loan. And with that, I will like to hear some questions, Michael.
Okay, perfect. As a real estate investor, what are the main advantages of co-investing in private lending deals?
What are the what, sorry?
So she's asking, as a real estate investor, what are the main advantages of co-investing in private lending deals?
Okay, good question. First, I want to mention the co-investment part. What co-investment means that the person that is bringing you the deal and that is telling you that it's a great deal because of this is also putting their money where their mouth is. For us, we decided to have a co-investment platform because we don't want to be a promoters. We want to be investors in our deals. And we normally do 10 to 20% of the deals, of the equity of the deals, with our own money, with our own capital. It's not a warranty because problems can happen, but at least everybody is on the same side of the table. Everybody is looking for the same interest, and everybody involved in the deal and invested in the deal will try to do whatever we have to do to be successful, to get the payoff, get the interest, and reinvest the money in a new transaction. So co-investment for us is one of the most important differences. I normally don't trust people that bring me deals and don't want to put anything into the deal, because if it's that good, I don't understand why they don't participate. Even if it's a small part, it's an important part for the person that brings me the deal. Also, you are having a first mortgage, so you are really secure. You have a real collateral. When you invest in fixed income securities, normally are unsecure. Normally you don't know what exactly is the asset that is going to be or work as collateral for your investment. Because we are not a fund, we are a deal by deal structure, you will always know what is the specific asset that you are lending on, or that you are being co-lender on, or buying a participation in the loan. And you will always get a third-party appraisal report. You can go and visit the asset. You can feel and understand the asset. And if you feel comfortable, you invest. And if you don't feel comfortable, you keep the control of deciding where you want to invest. So I think those are the two main differences: the co-investing and the control on deciding where you want to invest as a first mortgage.
So, Camille, do you want to answer questions about interest rates and points you're charging for your bridge
Sure.
loans? Okay.
It is in a case-by-case basis. So what we are going to say, what I'm going to say, is not one size fits all at all. But normally we do between 9.75, 9.5 to 12% interest rate. We do normally non-recourse loans because the collateral is the asset. Interest only, 2-year terms. Those are the traditional terms that we do. 1 to 2 point origination fees, depending on the structure and how difficult it is to structure and to manage the deal. And that's basically our typical conditions.
Next question, gentleman's asking regarding multifamily ground up. How does LinkVest or one of the subsidiaries participate in ground up construction with multifamily?
We are partners, equity partners, in six multifamily development projects in Florida. We only do Florida. We have one in Orlando, in Lake Nona, the medical city of Orlando, and the other ones here in Miami. And we do equity investments in multifamily. We are really careful who we partner with. That's the most important part for us. So we have only 2 partners, one in Orlando and the other ones in Miami is with the same partner. We believe in multifamily and we want to participate in more multifamily. You have to make sure that the market is good, the assumptions are good, because everybody is wanting to do multifamily, and that's part of the issues with real estate, and I think with any other industry. Everybody wants to do the same at the same time, and that's where the market gets crowded and gets difficult, and the assumptions stop working. But yeah, short term, mid term, we are really we like multifamily, and we are bullish in multifamily. We have done some financing for acquisition, for value add multifamily, either construction. But unless you are really efficient developing and doing the construction and really fast, we can be expensive. So the only way that it works is if you can build pretty fast. So it doesn't matter, it's not that bad, the financial cost, but you recover that because we are faster and much easier to work with than normally the traditional lenders and banks.
How is the private lending industry portfolio performing?
We have a 240, close to 250 million portfolio. Most of our portfolio is performing really well. Of course, we have had some renegotiations with some lenders. We did some, not forbearance agreements, but some agreements to delay payments, etc. We have a couple of loans in default and in foreclosure that we are working with the developers or the owners, trying to figure out. But overall, our portfolio is performing pretty well. And the main reason we think is we have good sponsors, of course. That's the main reason. And second, those sponsors have so much equity, their own equity in the deal, that they are not willing to lose the equity. When you finance 50% of an asset, if you do a $5 million loan on a $10 million asset, that means the other person has at least 5 or over 5 million invested in the asset. He is going to do whatever he has to do not to lose the equity. And he will figure out to pay or to bring a partner or to sell. But that's the main reason that our portfolio is performing pretty well, even during this crisis.
next question. What will what do you believe are the challenges that private lenders will be facing in 2021?
Measuring the risk and underwriting the risk. And we feel that now it's difficult to understand risk because we don't know yet, as I mentioned, we don't know yet the long-term or the mid-term implications on real estate assets and industries of this COVID situation. Access to capital and funding, because the private lenders need capital to be able to fund. Competition. I think there is a lot of people trying to get into this deal, into this industry. And when there is a lot of capital in the same industry, the conditions tend to become more aggressive. And I think that's a risk. We are not willing to be more aggressive. We rather deepen the relationship and work with the people that we've been working with than go out to the market with really aggressive conditions just to end up losing money. But what we think that can happen if there is a lot of competition and they are too aggressive. Those are basically the main points that I will say.
So, Camilo, I want to thank you for coming, presenting, talking about the current market, explaining exactly what it is you do. I hope that you come back again in November. We would love to have you back. And congratulations on the success of getting the deals done during COVID. It's just, it says a lot for you, and it says a lot for your firm. Thank you.
Thank you very much, Michael, and thank you for the invitation.